This week felt like watching the eye of a hurricane pass overhead, deceptively calm on the surface, but with powerful forces building all around us. While Bitcoin pushed to new highs and Nvidia celebrated crossing the $4 trillion milestone, the broader macro environment told somewhat of a different story. One of quiet tension, building pressures, and critical decisions looming just ahead of us. Let's start with the most important development for our portfolio. So, inflation data came in at the beginning of this week, slightly hotter than expected. And for the first time, we're seeing some evidence of the tariff impacts showing up in the economic data. The Federal Reserve is expecting more inflation to show in the data in July and August. Consumer prices in June posted their biggest increase since the beginning of the year, effectively killing any remaining hopes of a Federal Reserve cut this month. Jerome Powell also on the other front, we heard a lot of rumors that he might be resigning. This obviously sent shockwaves through the market. Gold ticked higher because obviously when you have some instability in the financial system, gold tends to sniff it out the fastest. And then we also see the dollar dump and the VIX jump. So obviously when I say these words, I'm talking intraday and I'm not talking the weekly time frame, for example. Once we start in the analysis, we're going to be looking at these charts and I'm going to be showing you on the chart the ticks that actually happened because of the fear that the possibility of Jerome Powell resigning and being replaced by someone else and the instability and uncertainty that might create until this transition happened. We actually saw that in the charts. So while these moves were temporary, they highlight just how sensitive markets are to any perceived changes in the Federal Reserve policy, especially on the monetary front. From a data point perspective, the Federal Reserve shouldn't be cutting aggressively by pausing at the moment and following the current stance that they have. It's somewhat makes sense. And also, while I'm going to be doing our analysis today, we will be looking at the interest rate cycles, and we can clearly see that we have broken a very important trend that has been ongoing for the past 40 years. I'm pretty sure the Federal Reserve definitely see this, and that's why the Fed is right now in a very difficult spot because as you know, the Trump admin is trying to push very hard on the Federal Reserve to cut rates. And the reason behind them doing so is because they want to be able to fund themselves, especially right now with the big, beautiful bill passing through, becoming a law. They need to actually finance around $5 trillion worth of debt. How will they be able to finance that is the question. They won't be able to do that on the long end of the curve, so they will not be able to issue bonds to do that and long duration bonds because the yields are very high. And if they do so at these current interest rate levels, there is a risk of locking in very high interest rates for a very long period of time. That's 5 years, 10 years, 20 and 30 years. And obviously, this will put a lot of strain and pressure on the budget of the US government because the interest expense will become so high to a point where the US government will never ever be able to run any fiscal surplus. The only way they can move forward would be to do fiscal deficits, and that's basically budget deficits. And if they go down that road, this will force more money printing in the future and will take the whole US government into a debt spiral, which a lot of analysts right now argue that we are already in one. As Lynn Alden says, there's nothing that stops this train, which is basically money printing and deficits, because already the interest expense is already too big. It's 25% of what the US government actually makes in terms of revenue. For that perspective, the US government doesn't want to refinance itself on the by issuing long duration bonds. The only choice that they have would be to issuing treasury bills, which have short duration and keep rolling them over until rates are lower, and then hopefully they will be able to finance using the long end of the curve. While the overall inflation picture remains relatively tame compared to a few years ago when it comes to the CPI number, the trajectory, obviously, as we said, is concerning. The Fed is stuck between politics and easing. And on the other hand, also, we see that the employment data and the economy is looking stable. So unemployment rate is at 4.1%, which is almost at near historical lows. And we see that initial jobless claims are also below the 270,000 mark, which at the moment, considering everything, we don't have any risk warnings coming from the data. However, we see that AI narratives and AI adoption, especially economists are expecting that AI adoption will eliminate a lot of entry-level jobs, and this will impact eventually the jobs data. The question isn't really if, it's when will this AI technology actually start hitting the economic data. A lot of people or a lot of economists are arguing that it will happen in 2025. What will be the consequences of this? Obviously, will remain to be seen. So most Fed officials at the moment are now waiting for July and August inflation data before making any moves, while also keeping an eye on trade negotiations ahead of the critical August 1st deadline. Because as you know, Trump admin decided to extend the tariff deadlines all the way to August 1st to give more room for countries to actually materialize. The US dollar did find support recently, but don't be fooled by this. There is definitely long-term challenges for the US dollar. The fundamental picture remains deeply concerning, with the de-dollarization and currency debasement trends only accelerating from here. The US government ran a $27 billion surplus in June, which is obviously very good. However, if you zoom out and if you just scroll down to this chart, which is the full year, fiscal year 2025, the US government is running $1.3 trillion worth of deficits. So, yes, in June we ticked up, but the main trend is very clear. So this is the reality of the current fiscal situation, occasional monthly surpluses buried with an ocean of structural deficits. So this dynamic creates a perfect storm for currency debasement over the long term. High deficits meaning high spending, and this is the inevitable need for more money printing in order for them to finance all this debt, which will make the dollar temporary strength exactly that, just temporary. The long-term trend for the dollar will most likely be falling down. We have two major events on August 1st that will likely determine the market direction for the rest of the summer. The first one will be the quarterly refunding announcement. And this is basically the decision of the Treasury Department and the Senate on how they will fund the big, beautiful bill. Which kind of bond duration will they issue? This will definitely reveal the Treasury's financing strategy for the $5 trillion spending bill. If they opt for more Treasury bills versus bonds, as was done in the previous administration and most likely will be done also this time, it could be stimulative for markets, but because financing using treasury bills usually is pro liquidity in the system. The second very important event that's happening on August 1st is, as we said earlier, the tariff agreement deadline. How this plays out will significantly impact inflation expectation and Fed policy going forward. Also, moving forward, and specifically in the second half of July, we have the Q2 earning season for US businesses and this for public companies. This already started this week and will likely continue until the end of July. And obviously, this will bring volatility with it because some companies will outperform the estimates and some companies will underperform, and obviously this will bring some volatilities along the way. Right now, what we're seeing in the market is a classic representation of a melt-up scenario that could obviously quickly in the near future turn into a meltdown. And as you know, if you have been following us on these calls, we believe that there is a technical indicator on the volatility index for equities that will most likely trigger once we fall below the 15.5 level. So this is the volatility index here. And usually when this metric falls below 15.5, then it's sort of a countdown for another volatility shock. And we expect that to come somewhere in August and September. So right now we are in a melt-up scenario and it doesn't look like there is any sell-off beneath the surface. So most likely the trend that we're seeing at the moment will continue. BTC hopefully will keep moving higher, potentially to the higher 130s range before finding a floor and potentially correcting alongside the equities market for a while. And then by then we'll see what will happen. At the moment, we are seeing significant speculation and money flow, but this creates vulnerabilities down the road as debt and interest expenses compound. So right now, with the big beautiful bill and all the money that will come with it and all the tide that will come with it, obviously it's creating a lot of speculation, a lot of FOMO, and we see this clearly across asset prices with the S&P at all-time high, crypto market at all-time high, and asset prices are just shooting through the roof. But obviously, down the road, at some point, correction is going to come for sure, no doubt about that. Especially because fundamentally there is so many problems in the system. Currency is being debased really quickly, and there is a trend of de-dollarization. And when we have a de-dollarization trend, the credit market tends to feel that, and yields will rise and spike. And with rising yield, obviously, this will put strain on the whole economy. The markets right now remain tradable in the short term, but the underlying tension suggests we should be prepared for increased volatility, especially as we head into the seasonally weak period from August through mid-October. This is precisely when we should start building our hedges. And as you know, we started buying put options on our BTC, even though, in my opinion, I believe it's a little bit early, but it's better for me to be prepared ahead of time, especially because there is so many risks across the macro landscape, left and right. And it makes sense to start hedging little by little before the general consensus, because once the trend moves, it will become extremely expensive for us to hedge our positions. So from now, it's good to start building our hedging position until hopefully by the end of July, we should be fully hedged in our main asset, which is in our model portfolio is Bitcoin. So looking beyond the immediate market moves, we're witnessing the slow motion unfolding of a currency crisis that began years ago, specifically, I would say in 2008. The de-dollarization trends and yield pressures are real risks, but they take time to actually materialize. So do not expect, because of the de-dollarization and higher yields, something to happen tomorrow or next week. These trends take time. So think, if you want, equivalent to the year 2006 leading up to 2008 crisis. This is kind of the timeline of these kind of fundamental problems taking time to actually materialize. So what does this all mean for our portfolios? For our community, this reinforces our core thesis that traditional financial systems are showing increasing signs of strain, and those who position themselves in decentralized sovereign alternatives will best be positioned for what's coming. The path forward requires patience, discipline, and a clear understanding that we're building wealth for the long term while navigating short-term opportunities in our active portfolio.